In California, dealing with your late parents' estate can be a headache. Whenever there's real estate involved, it can get complicated. But if you think about it, there are really only two options: keep the property or sell it. But then the questions come in. Are you sure you can afford to keep the property? Or is selling the property the better choice? What's the smartest way to get each beneficiary the most money? Wouldn't it be great if you could talk to someone who deals with these questions every day? We're Commercial Loan Corporation, or C-Loan-C, and we can help you get through this tricky situation by getting you all the facts before you make this important decision. And if you do decide to keep the property, we can provide you with funding that will help you save thousands of dollars in property taxes. C-Loan-C has consulted with over 5,000 families like yours, and we've provided funding for over 800 trusts and estates. But why do trusts and estates need funding? When one or more of the child beneficiaries decides to keep the family property, there's a way to keep the parent's property tax base, saving thousands of dollars each year in property taxes. Normally, property taxes are reassessed every time the property changes hands. However, there are certain steps to avoid this reassessment when using the Proposition 19 parent-to-child transfer to obtain a full exclusion for property tax reassessment. The key is to make sure the distribution from the trust or estate is equal for all the child beneficiaries. Let's look at an example. Say your estate has 3 beneficiaries. Your family home is paid off and valued at $900,000, and there are no other assets in the estate. With an equal distribution, each of the 3 beneficiaries would be entitled to $300,000. In this example, you want to keep the property while your siblings want cash. You can't cut the house into thirds, but there is another way. Proposition 19 allows the trust or estate to borrow enough money from a third party to make an equal distribution to all beneficiaries, as long as the third party is not the child acquiring the property. Here's where we come in. C-Loan-C will lend the trust or estate $600,000, so that the children wanting cash will get $300,000 each. You, the child keeping the property, will get a $900,000 house with a $600,000 loan on it. That is $300,000 in equity. That makes the distribution of the trust or estate equal. And since you're keeping your parents' property tax base, you're saving money. On average, our clients save over $6,500 per year, every year, on property taxes. And there's more. If you're over 55 years old, Proposition 19 allows you to transfer your property tax base to another property in California up to 3 times. That means you're able to take your low property tax base to another property. So is borrowing from a third party always the right move? Not always. Every case is different. That's why C-Loan-C will do a cost-benefit analysis for all of the beneficiaries, free of charge. We'll show you the complete process of obtaining an exclusion for reassessment and securing financing, a comparison for each beneficiary if the property is sold or kept, your tax savings, a complete breakdown of all loan costs, interest rates and payments for financing, and how long it will take for tax savings to cover all your loan costs. In some cases, it will make the most sense just to sell the property. C-Loan-C can also provide funding for trusts and estates that want to fix up a property for sale to get the highest sales price. So all beneficiaries can work together to all get the maximum benefit. Contact us today. Give us a call at 877-464-1066. It doesn't always make sense to keep the property you inherited, but it always makes sense to know your options.